Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today we're going to talk about opening up a Roth IRA for your child. I've received a lot of calls on this topic over the past couple of years, and I wanted to cover the pros and cons of doing this as well as the mechanics of opening up a Roth. Awareness, at least I think about this, stemmed from a viral video on TikTok recently that talked about how Beyoncé and Jay-Z opened up a Roth for their daughter, Blue Ivy, and she's going to have $6 million saved in it by the time she's in her 60s. So with a headline like that, a video like that, it'll obviously pique people's interest. So let's look at some of the details. If we look at the numbers on Roth IRAs and kids, yes, it is possible that a child can have over $6 million saved in their Roth by the time they are 65. And it really comes down to the power of compounding and the tax-free aspect of the Roth IRA. The Roth IRA works. If a 10-year-old saves $7,000 a year from age 10 to 65 in a Roth account that earns 8% per year, yes, they will have over $6 million in that Roth account by age 65. So part of that reason is compounding, which highlights the benefits of saving early. And the other, which we'll talk about, is the benefits of tax-free investing. That's one of the characteristics of a Roth. Now, to show you about compounding, we're talking about having that much money if they start when they're 10. If they wait until they're 22 years old, which is typical for a lot of people, they wait till they're to start saving in something like a Roth until they graduate college, have their first job. If they saved that $7,000 a year with the same 8% return from 22 to 65, they'll have $2.6 million saved at that time. So you're looking at over 6 to 2.6 just based on a 12-year difference starting period of $7,000 a year. However, starting to save at 22 is still definitely a good strategy as well. Now let's look at the tax-free benefit of saving in a Roth. So if the same person starts at 22, saving that $7,000 a year into their Roth, and instead of doing it in a Roth, they did it in just a regular taxable investment account, they would have $1.5 million versus the $2.6 million in a Roth because of the tax benefit of a Roth. Now, in our original example, we talked about starting to save at age 10. And if they did that in a Roth, they'd have over $6 million. If they did it in a taxable account, they'd have $3.1 million. So everything is the same in both of these scenarios, except one is starting early versus starting later. The other is getting the benefits of the tax benefits in a Roth versus investing outside a Roth. For the assumptions, we're assuming they're invested in the same exact thing. So let's talk a little bit about the tax benefits. The way a Roth works is that you contribute after-tax money to the account, but you never have to pay taxes when you take the money out, as long as you meet some certain criteria. The main one is that you're over 59 and a half. However, you can take out your contributions, which we're talking about here is the $7,000 per year at any point. And the reason, because you've already paid tax on those contributions, the IRS cares less about what you do with those since you've already paid tax on them. This is the opposite of a traditional IRA, which most people are familiar with, your typical traditional 401k or your traditional IRA, and that's where you contribute pre-tax money to the account, but you have to pay tax when you take the money out. So as an example, let's say you earn $100,000 this year, you put $7,000 into your traditional IRA, you'd pay income tax on $93,000. You're getting that deduction on the $7,000. Now, let's say, though, over a period of time, that $7,000 grows to $20,000. You'll pay income tax on the full $20,000 when you take it out of your account. Conversely, with a Roth, you make that same $100,000, you're going to pay tax on $100,000, even though you're putting $7,000 into a Roth. Now, that $7,000 grows to $20,000 over time. When you take the money out, again, if it meets that certain criteria of a Roth, you won't have to pay tax on any of that money that comes out. I mentioned earlier about the Roth compared to a taxable account. The way the taxable account works is similarly to a Roth, you add post-tax money to it, so you don't get that tax deduction for any money that's added to the account like you do for the traditional IRA. And then in a taxable investment account, every year you get a 1099, which shows any interest or dividends that account earned, as well as any capital gains. So capital gains is when an investment in the account is sold for more than it was purchased for. So if that's the case, all your investment sales, they're netted for the year. So any ones that you had gains versus any ones that you had losses on, they're netted. And at the end of the year, if there is a gain, you would owe tax at the capital gains rate. Now, we're talking about three different types of accounts: Roth, traditional IRAs, as well as taxable investment accounts. For the most part, you can invest in the same types of investments in each of those three accounts. There are some limitations on IRAs what can go in there, but for the most part, it's pretty much anything that you can think of. You'd be able to invest the same in both those investment accounts. All right, so after going through this, there's clearly a benefit to the Roth IRA. So let's pivot now to the specifics on starting a Roth for your child and what does that mean. The biggest criteria for doing this is that your child has to have earned income. Earned income is income from work. It's not passive income that they generate from investments or other assets that they have. So what's earned income? You can't just say, I'm going to open up a Roth for my child. I'm going to deposit $7,000 into it and let this thing grow over time. Because what's the downside is you can actually probably do that, but there's the chance that it gets challenged by the IRS, and then you have to prove that your child actually does have earned income. They are, working and they're generating income. You can put up to that amount into a Roth, up to a maximum of $7,000 a year. So the question I get is, well, does the IRS actually look at this? And yes, they do scrutinize, and they have challenge situations where I think we see this the most common, especially with younger children, is they get added to the payroll of a family business. The IRS has challenged this before when the child is added to a family business, especially if they think that the primary motivation is tax avoidance rather than legitimate employment. So here's what the IRS looks for and some common pitfalls that can lead to those challenges. So first is bona fide employment. And this is the most critical aspect of this whole concept we're talking about, is whether the child is performing actual, necessary, and ordinary services for the business. So this means they're doing something that you genuinely would pay an unrelated third party to do. So as a challenge example, if a parent claims their 5-year-old is a marketing director or their 10-year-old is doing complex bookkeeping, it's highly likely to be challenged, although we're seeing kids younger and younger, especially on the technology side, being able to do some pretty complex things. But the work must be age appropriate and relevant to the business's operations. Next thing that can get challenged is reasonable compensation. So the wages paid to the child must be reasonable for the work performed when you take into account the child's age, their experience, and then the prevailing wage for similar work in the market. So here a challenge example is you pay a child $20,000 for a few hours of occasional filing and some administrative assistant work that if you hired someone outside, they'd earn less for doing that same amount of work. The IRS will look for inflated wages that are designed to shift income from basically parent to child. Tax court cases in this, they involve situations where bonuses or large payments are made at year end, which the court looks at like disguised gifts or support rather than actual compensation for work. Next thing to be aware of is documentation and record keeping. So just like you want to do this with any other employee, it's a good practice. Proper records are essential. So this includes like your job description, outlining what your child is going to do for the company, specific duties, your timekeeping records. So you want your timesheet showing the hours that your child worked, your payroll records, pay stubs, W-2 forms, evidence of the work performed. Do they have the organized files, social media posts, completed projects, whatever they are doing, you want to at least keep some evidence of what they did. So in here, a challenge example is the lack of any formal documentation, or if you treat the child differently from other employees in terms of record keeping, that will raise suspicion. So if there's no proof that the work was done or how many hours were worked, the IRS can disallow the deductions and they make you back out your Roth contributions, saying that the Roth contributions are invalid. So it definitely can get messy. Another thing to look at is compliance with labor laws. So even with family businesses, federal and state child labor laws apply regarding things like age restrictions, permissible occupations, and working hours. So here a challenge example is employing a child in a prohibited occupation for their age or having them work more hours than allowed by law. That can indicate a lack of legitimate employment. Finally, another thing to look at is the business structure and payroll taxes. The tax treatment of a child's wages varies depending on the business structure, whether the parent's business is set up as a sole proprietorship, a partnership, an S Corp, a C Corp. For sole proprietorships or partnerships where only the parents are partners, wages paid to the child under 18 are generally exempt from Social Security and Medicare taxes. Payments to a child under 21 are exempt from federal unemployment taxes. However, income tax withholding is still required regardless of age. Then, conversely, for corporations, with your S Corps or C Corps or partnerships where not all partners are parents, wages are subject to all employment taxes, which includes Social Security, Medicare, FUTA, and income tax withholding, regardless of the child's age. So here a challenge example is incorrectly classifying the child's wages to avoid payroll taxes when the business structure doesn't allow for it. So that can lead to penalties. And then specific cases might be obscure in this area, but the principles applied by the tax court, they're consistent with the business structure. So the IRS, the tax court, it'll look through the form of the transaction to its substance. So if the employment of the child is merely a scheme to funnel money into the Roth IRA or to get a business deduction without legitimate work being performed, it can or will be challenged. So some like just general cases, like parents paid children for chores around the family home, attempting to classify them as a business expense. The IRS generally views personal chores as distinct from business-related work. The work that was claimed was not ordinary or necessary for the business. A young child cleaning the office that didn't need daily cleaning or performing tasks beyond their capabilities. The wages were deemed clearly excessive for the work performed, far exceeding what an arm's length employee would receive. So arm's length meaning one that's not your child. And there was no documentation that they had, no timesheets, job description, formal payroll process. So to avoid IRS challenges in this, you really want to make sure it's legitimate work, reasonable pay, you have documentation, you're adhering to compliance to all the federal and state labor laws, and that the structure of the business allows for whatever deductions or whatever tax withholdings that you're taking part of. Now, I know they went through a lot of this of what not to do or what can get challenged, or it's not meant to scare people off. It's just saying, you follow these best practices, you can confidently and legitimately employ your children in the business, take advantage of the tax benefits, which includes enabling a Roth IRA contribution for their kids. If you can meet those requirements, if it is something you can do, the Roth IRA for a child, it's a great tool to set your child up for financial success. A couple other notes on the child's Roth IRA. Because they are a minor, they have to open up what's called a custodial Roth. And typically this is where a parent acts as the custodian on the Roth IRA. So it gives the parent control of the account until the child hits the age of majority. So that age varies state to state. It's typically either 18 or 21. So whenever they hit that age, the child gains full control of the Roth, it's turned over, and they can essentially do whatever they want with it. So I'm not trying to dissuade people from doing it if it makes sense. If you are able to add them to a business, or if they're, let's say, just legitimately they're at the age, they're 16 years old, or they're at their age where they are working, whether it's a summer job or something they do after school, it's a great thing. Saving early, getting the tax benefits of a Roth is definitely something worthwhile to consider. If starting a Roth is something you are interested in exploring, I'd recommend talking to a financial professional just to make sure that you are qualified to do it or you do meet the criteria to do it. I'm happy to have that discussion with you, which you can set up at bautisfinancial.com/call. Thanks for tuning in to today's episode.
Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.